Listen up. We're skipping the fluff and standard YouTube intros today. If you're here, you want to know exactly how I'm navigating institutional order flow this coming week in this explainer. The algorithmic footprint is clear, and I'm laying out precisely what I'm watching, entering, and targeting. No guessing, just strict, rule-based execution. Let's get straight into it.
This week, I am looking to buy gold. My weekly bias is strictly bullish. My ideal entry zone is exactly between 4,100 and 4,130. I will absolutely not buy above that. My stop loss is hard set at 4,070. My first take profit target is 4,190. After that, my second target is the liquidity pool at 4,250, and my final target is 4,300. This setup offers an expected risk to reward ratio of 1 to 3, stretching all the way up to 1 to 5 or more. Here's the evidence.
So why does this trade exist? Let's check the institutional evidence.
With over 15 years in the trenches trading gold, I only execute when the footprints align perfectly. Look at the weekly chart. The market intentionally swept massive sell-side liquidity just below the 3930 level. It engineered a deep purge to trap early sellers, collected that liquidity, and immediately printed a strong bullish expansion candle. That is a massive institutional rejection right there.
Stepping down to the daily chart confirms my bullish bias completely. After that sweep, we got a violent change of character to the upside. The algorithm displaced with extreme aggression, leaving behind a massive, clean daily fair value gap sitting wide open between 40.20 and 41.20. This is an absolute institutional magnet.
Refining this for our actual entry is absolutely crucial. Down on the 4-hour chart, we have a prominent fair value gap and a validated order block spanning from 40.80 up to 41.30. This perfectly overlaps with the daily gap, creating a highly specific discount array. That is exactly why 4100 to 4130 is the precise point of interest I'm waiting for.
Let's move on to tactical execution and waiting for the Judas Swing.
Having a level is only half the battle. Execution is literally everything. Look at where gold closed on Friday. The current price is 4176.44. We are deep in the premium of this immediate dealing range, hovering right below buy-side liquidity at 4190. Right now, there is absolutely no valid setup. Do not blindly buy here. If you hit market buy at 4176, you are acting as retail liquidity.
Here is my exact execution model. Step 1. I am waiting for a Judas swing down into our 4100 to 4130 fair value gap during the London or New York kill zone. Step 2. Once price taps that zone, I'm dropping to the 5-minute or 15-minute chart to confirm a market structure shift. Step 3. Once confirmed, I execute my long position, immediately targeting the 4197 buy-side liquidity.
Now, I want to share a hard-learned lesson about the cost of chasing price.
Earlier in my career, well over a decade ago, I blew multiple funded accounts making the exact mistake that retail traders are going to make on gold this coming Monday. I remember one specific week vividly. Gold was printing massive green candles, momentum was screaming upward, and price was consolidating right at the highs, exactly like it is right now at 4176. I had identified a beautiful discount fair value gap lower down, but the fear of missing out kicked in hard. I convinced myself it wouldn't retrace and the order flow would just break out. My discipline evaporated. I abandoned my trading plan entirely. I bought the premium breakout right at the weekly highs, terrified of missing the move, and over-leveraged my position. For about 2 hours, I was sitting in profit. I felt untouchable. But then the New York kill zone opened and the algorithm immediately reversed. It engineered a violent, aggressive sell-off that plummeted straight down like a rock. It blew right through my stop loss in seconds, triggering a massive wave of retail liquidations. I sat there completely paralyzed. And you know where price finally stopped? It stopped precisely in the fair value gap I had identified days before but was simply too impatient to wait for. The exact moment it tapped that discount array, it rallied over 300 pips to the upside. It left me sidelined with a massive loss, watching my original trade play out perfectly without me. That gut-wrenching pain burned a permanent rule into my psychology. The market doesn't reward impatience, it liquidates it. If price doesn't hit my precise point of interest, I do not have a trade. Period.
That story brings us exactly to the reality of this week. Amateurs fund the liquidity pools because they trade on pure emotion. Professionals sit on their hands and wait for the point of interest. I will wait for gold to drop into that 4100 to 4130 zone. Period.
Let's break down next week's contingency scenarios.
As professional traders, we react to what the market does with strict conditional logic. Scenario A is our high probability play. If price drops into the 4100 to 4130 point of interest during a kill zone, I wait for a lower time frame change of character and I execute long. But scenario B, what if price just takes off from 41.76 and rallies to our 4,300 target without ever retracing? My response is simple. I do absolutely nothing. I will not chase the market.
But what if I'm wrong? Scenario C outlines my exact setup invalidation. My absolute line in the sand is 40.70. If we see a forceful 4-hour or daily candle body close below 40.70, the bullish displacement is completely invalidated. If that structure breaks, I pivot my plan entirely. I will flip short, selling on a retest of the broken 40.80 level, and I will target the 39.80 weekly lows. Zero ambiguity. We adapt and move on.
Finally, we need a catalyst to drive price into our zones. For scenario D, I'm watching the ISM Services PMI on Monday and the highly impactful FOMC meeting minutes on Thursday. These high-impact news events are the exact drivers algorithms use to create that desired Judas Swing, rapidly sweeping liquidity into our 4,100 discount array before expanding higher.
However, you must manage risk around these events. My strict rules: absolutely no trading 30 minutes before or 30 minutes after the ISM, PMI, and unemployment claims releases. Let the algorithmic stop hunts clear out retail traders first, then trade the aftermath. And absolutely no overnight scalping during the FOMC minutes. Just stay out of the way.
Let's wrap up with final plan and execution.
Okay, let's bring this all together. You now have my entire institutional master playbook for XAUUSD this week. You know my bias, the exact entry zone, the stop loss, the take profits, and the invalidation conditions. Your edge depends entirely on your discipline to execute the plan without hesitation. For those of you serious about implementing this kind of structured, rule-based approach, you need a broker with institutional-grade execution. Open an account with FXTM. They provide the deep liquidity and tight spreads required to execute precise strategies flawlessly. We aren't here to gamble, we wait for the setup, manage our risk relentlessly, and execute with total confidence. Stick to the plan this week, protect your margin, don't chase price, and I'll see you in the markets.